Two, three.
Hello everyone. Today we are presenting on the book Value Investing and the Behavioral Finance by Parag Parikh. This book goes beyond traditional investing concept and highlights how psychology influences financial decisions. It explains how investors can identify undervalued stocks and build long-term wealth by staying disciplined and avoiding common behavioral mistakes in the market. Next slide. Myself, Pranjal Dudara, I am going to explain the first two chapters of Value Investing book by Parag Parikh sir. So here the author explains the architectures of achievement, which means how success failures are built in our life. Every person is driven by basic needs like security, comfort, leisure, love, respect, and fulfillment. And our actions are influenced by these needs. At the same time, we all have common human traits like laziness, greed, ambition, self-respect, ignorance, and vanity. These are natural, but if not controlled, they can lead to poor decisions. One important concept explained in the E factor, which means choosing the fastest and easiest way to get things. For example, students often study only a month before the exams. They may pass, but in the long run, they actually learn, but it affects their career. Because of this behavior, many people end up choosing easy options, forming weak habits, not reaching their full potential. On the other hand, success comes from the self discipline, which means doing what is necessary, even if it's difficult. This builds strong habits and character over time. So, the key message from the author is that success depends on focusing on the long term actions rather than short term comfort. Next slide. Next page. This page explains the structure of equity returns and how market behavior creates difference between expected and actual return. First, there is a difference between perception and reality. Equities are generally perceived as risky because of price volatility, whereas fixed income appears safe due to the stable prices. However, in reality, equities act as a hedge against inflation and have delivered higher long-term return around 19.67% compared to 10.4 from the fixed income, like PPF. This leads to core paradox. Although equities generate high long-term returns, investors often realize poor returns. The reason behind this is behavioral bias, crowd-driven pricing, and emotional decision making. To understand this, total return can be broken into three components: fundamental plus speculative plus dividend. The fundamental components come from the earning growth, while the speculative come from the changes in the PE ratio, which is driven by the market sentiments and such as greed and fear. Speculative returns can be calculated using the formula earning per share multiplied by change in the P divided by the prices paid. So here there is a case of ABC Limited. Demonstrate this clearly. The company's grows its earning by 20%, but the return vary depending on the PE changes. If the PE remains stable, the return is 20%. If the PE expands, the return increases to 50%. If PE contracts, the return is negative 10%. This shows that the same business performance can lead to very different outcomes due to valuation changes. Next slide. Moving to the market behavior, the Sensex analysis of 1991 to 1992 shows that total return was 37%. Out of 5.8% come from fundamental, while 31 came from the speculative PE expansion. This indicates that the majority of returns were driven by the sentiments rather than the actual business performance. Return anomalies further support this behavior. 1994 and 1997 earnings grew at 33.6% CAGR, but the Sensex delivered negative returns due to high initial PE and valuation compression. Similarly, during 2000 to 2002, earnings grew, but investors still experienced a negative return because of PE contraction and pessimism. Finally, investors' behavior play a key role. The majority of investors follow the crowd, react to news, and attempt market timings, while a smaller group follows a disciplined long-term and contract approach. In the conclusions, equity returns are not determined only by the earnings growth, but are significantly influenced by the changes in the valuation and the market sentiments. Now, the next slide will be explained by Sam.
Thank you, Pranjal. Now we understand how the author explains that investors generally follow two broad investment styles: value investing and growth investing. Value investing involves buying stocks that are trading below their intrinsic value based on careful analysis of future cash flows and fundamentals. In contrast, growth investing often focuses on popular companies with high expectations where investors are willing to pay very high prices for future growth. Even if value investing is more profitable in long run, there are certain obstacles that leads to investors moving towards growth stocks. Some of these obstacles include error of judgment, where investors assume that a well run company must automatically be a good investment even if the price is too high. Another major bias is loss aversion, when investors feel the pain of losses more strongly than the pleasure of equivalent gains. There is also instant gratification, where investors prefer quick profits instead of patiently waiting for undervalued stocks to realize their true value. At the same time, several behavioral traits push investors towards growth stocks. These include the availability heuristic, herd mentality, chasing fads and popular trends, and the realization trap. The author concludes that investors often follow the crowd and ignore proper valuation techniques, which leads them to overpay for popular stocks rather than focusing on intrinsic value. The author then introduces the concept of contrarian investing, which is very closely related to value investing. A contrarian investor is someone who goes against conventional market wisdom when identifying investment opportunities. Contrarian investors look for signs that market sentiment has become excessively optimistic or pessimistic, creating mispriced securities. However, the author explains that following a contrarian strategy is difficult because of psychological and organizational constraints. Psychological constraints arise thinking, the false consensus effect, buyer's remorse, ambiguity aversion, and the illusion of control. These biases make investors uncomfortable about taking positions that differ from the majority. There are also organizational constraints, especially for professional investors. Fund managers often face career risk, benchmark pressures, and the desire to appear correct in front of clients and colleagues. As a result, many investors follow or prefer to follow the crowd rather than risk being wrong alone, even when contrarian opportunities exist. To demonstrate this concept, the author presents a study comparing conventional and contrarian portfolios. The study examined the performance of the top 10 high PE stocks and the top 10 low PE stocks between 1995 and 2006. The conventional portfolio consisted of high PE stocks, which were popular companies with optimistic market expectations. The contrarian portfolios consisted of low PE stocks, which were relatively neglected or undervalued by the market. The results showed that the contrarian portfolio generated stronger long term returns and experienced more stable performance compared to the conventional portfolio. This research supports the author's central argument that market psychology often leads to mispricing, and disciplined investors who focus on valuation rather than popularity can actually achieve better long term results. Thank you. Now, my friend Jalaj will continue.
Thank you, Sayami. As we all know, when a high price is paid for an asset compared to its intrinsic value, the returns are bound to suffer. This is what happens when investors chase growth stocks. They get into the growth trap and their long term returns take a hit. To become a successful investor, deep understanding of fundamental is essential. However, in the journey of becoming a successful investor, one has to overcome several behavioral anomalies. Let us discuss them in brief. When one starts believing readily available information about a new idea or concept through an event and finds the stock price going up, they feel it's a growth stock and start investing, which ultimately hits their return. Sources of information like media plays a very huge role in it. Going on the herd makes one think that they should go with the flow as everyone is making money. So why not they? It also makes one believe and justify their wrongdoing as right. Overconfidence at times make one ignore new information and believe that no one knows the market better than them. At times, one behaves under the influence of others. When one follows someone with an assumption that the person is right and has proper knowledge about the stock, one neglects their own understanding and due diligence. At times, one makes a perception about the stock on the basis of a single factor rather than considering the overall picture. Let's move to the next slide. At times, what looks like an opportunity to an investor could be a trap. To understand this, let's take an example of Infosys Limited. In the beginning of year 2000, Infosys was trading at a PE ratio of 201 with a growth of 37%. Shareholders would have been able to reap the benefits of such stellar growth only if the PE ratio had been maintained at 200 for the next 7 to 8 years, which was not just impossible but also not sustainable due to such high expectations. Despite excellent performance by Infosys, there was no capital appreciation for shareholders. With this, let's move to the next slide. One has a common understanding that if the price of a commodity goes up, the stock price of a commodity stock will also rise. Commodity stocks provide investors an opportunity to earn returns. The valuation parameters of commodity stocks are different from usuals because of their cycle and varying capital structures. It is important to understand that investing in market leaders gives an upper hand to investors in the form of strong balance sheets, optimum resources, less debt, pricing power, and the ability to withstand downturns. Such companies are able to survive longer in bad times and ride through the commodity cycle. Lower production cost reaps higher profits. They also have pricing power over their competitors, which helps them gain market share. In commodity companies, the level of debt decides the profitability in the downturn of the commodity cycle. High debt could impact earnings and lead to a debt trap in tough times. Now, Naman will take from here.
Thank you, Jalaj. To to understand how wealth is created in commodity cycles, we must look at leader versus laggard re-rating metrics. In the sugar cycle of 2003 to 2006, Balrampur Chini was the efficient leader, low cost and low debt, resulting in a strong CAGR 185%. However, the high cost laggards, Shakti Sugar, which was debt heavy and inefficient, actually outperformed with a 265% CAGR. This occurs because of the Graham principle. Once commodity price hits a critical inflection point, the market stops penalizing a company for its high production costs. Instead, the market shifts its entire focus to the EPS trajectory. This leads to what we call the double whammy EPS acceleration curve. First, you have the low base effect. Moving a margin from 2% to a 10% creates a wildly more aggressive mathematical trajectory for the stock price than a leader moving from 20% to 40%. Second, these laggards often possesses as tax shields. Their legacy losses and high interest payments shield bottom line, causing EPS to explode the moment revenue spike. In these scenarios, the traditional value investing parameters fail because speculative logic specifically demands these structural laggards. Our next slide. Moving to the broader market, we see a massive disconnect between the private and public sectors. On the market surface, the private sector trades at 19x multiples, while the PSU trade at 40 to 50% valuation discount at 12.4x. This gap isn't always fundamental. It is often the result of cognitive drag. Investors fall into three psychological traps. Representativeness, people assume that government run automatically equates to low growth inefficiency, which causes them to ignore industry leading performance. Confirmation bias. Investors fixate on specific laggards like MTNL to validate their negative views, while completely overlooking structural outperformance like BHAL and SBI. Availability heuristic. Vivid news cycles focusing on red tape override the fundamental reality of strong operational performance. Ultimately, the biggest bargains emerge when these built-in market expectations fall completely out of sync with the underlying fundamental reality. Next slide. The final piece of the puzzle in the asset architecture that supports these valuations. The value of these companies is built on three pillars: hidden value such as unpriced legacy real estate and mining leases; prohibitive replacement cost, where replicating the physical footprint would be too expensive for any new competitor; and massive scale, which includes decades of accumulated infrastructure like refineries and vast banking networks. The historical reality from 1991 to 2006 confirmed this. During that window, 19 PSUs completely outperformed the Sensex, driven largely by this unpriced bricks and mortar value. For example, the Hedging Corp of India delivered 79.77% CAGR and NMDC delivered a 77.15% CAGR. When you buy these assets at a discount, you aren't just buying a cash flow, you are buying a massive, unreplicable physical presence that the market has fundamentally undervalued. Thank you. Now the next slide will be explained by my colleague Pratham.
Thank you, Naman, for your explanation. And now I will take forward the discussion to chapter 8 and 9. We understood that investors are not always rational. Instead, their decisions are influenced by psychology and emotions. One important bias is herd mentality, where investors follow others blindly. When others become popular, rush into that sector. Just because others are making money, this creates a sector bubble cycle. First, there is innovation, then media hype, then herding by investors, then overvaluation, and finally, a crash. Another bias is availability heuristics, where people depend on decent news or trends instead of proper analysis. We also have overconfidence bias, where investors believe they know more than they actually do. All these biases together lead to chasing hot sectors, overpaying for stocks, ignoring fundamentals. So, the key takeaway here is controlling emotions and avoiding sector hype is important for successful investing. Sayami, can you please change the slide? Moving to chapter 9, a very important concept here is growth trap. Investors are attracted to fast growing and popular stocks, but they ignore whether the price is justified or not. This leads to paying a very high prices expecting future growth. And when that does not happen, the stock prices falls, resulting in losses. Another concept is the IPO illusion, excitement and hype. They assume that all IPOs will give high returns, but in reality, most IPOs underperform in the long run. So, chasing trends and new opportunities without analysis can be very risky. Sayami, can you please change the slide? Sayami, to stock markets are not driven by human emotions like greed and fear. Investors often chase hot trends and popular sectors, which leads to growth trap. There are two clear approaches: speculative investing, driven by hype and emotions, and value investing, driven by fundamentals and patience. Speculative investing leads to losses, while value investing leads to long term wealth creation. So, the key message is avoid the crowd, think rationally, and focus on value. I will now hand over to Vanshika.
Thank you, Pratham. I'd like to start with my first topic, which is behavioral trap of indexing.
Most people choose the index for two main reasons. First, lower fees, an instant win for the mind, and second, crowd solace, the comfort of losing with the herd rather than being wrong alone. However, the structural flaw is quantity over quality. Since the Sensex uses market cap as the criteria for entrance in the index, it mechanically buys stocks at their peak. We saw this with DLF and Reliance Communications, which entered the index simply because they were big during the frenzy and not because they were good businesses. As a value investor, the author views this as a heuristic trap, a mental shortcut. While the crowd pays fancy prices for popularity, true value lies in buying out of favor companies before they become the favorites. Next slide, please. This slide provides the empirical proof of index failure. A long-term Sensex study reveals a massive wealth gap. A portfolio of laggards, the stocks kicked out of the index, grew to 79 lakhs, while the newcomers grew to only 31 lakhs from the same base. We see this price of fancy in the tech bubble, where old economy, Tata Chemicals, was dumped for Satyam. The laggard returned 31%, while the newcomer returned basically zero. The strategy is re-indexing, buying fundamentally sound companies exactly when the index drops them. While low fees are the base, the real profit lies in having the emotional courage to buy what index is supposed to sell at a bargain. Next slide, please. Next, the anatomy of a bubble trap. Bubbles start with a valid foundation, like a legitimate need for infrastructure. But the crowd takes a good idea too far. This creates a snowball effect where envy drives investors to ignore reality. We can diagnose this using the behavioral table. The availability heuristic makes us overreact to vivid news, while overconfidence leads us to mistake a lucky bull market for a skill. In the final stages, the greater fool theory takes over. Investors pay insane prices like Reliance Power at a 900 PE, hoping to flip the stock to someone else. The takeaway here is to look for silent evidence and stand apart when valuations reach these signs of insanity. Next slide, please. Finally, this slide shows how to survive a bubble. We spot them through commodity euphoria or disproportional growth. Like the Sensex growing sixfold while GDP grew only 9%. The value investor shield treats valuations as absolute, avoiding triple digit PEs and tips where smart money has already exited. The rules are pretty simple. Never get married to a stock. If you wouldn't buy it with fresh cash today, sell it. Crucially, avoid the house money. Do not treat profits as free money for recklessness. Ultimately, investing is 10% knowledge and 90% emotional discipline. Success is about keeping money in your pocket, not letting it go to your head. The next topic will be explained by Krisha.
Thank you, Vansika. I'm going to talk about the behavior finance and what really drives the market movement. We often believe that market moves because of a company performance or strong fundamental. But in reality, market movement are largely driven by human emotions, especially fear and greed. In short, stock often away from their intrinsic value. This happens because investors are not always rational. They react, they react emotionally, follow trend, a copy what others are doing. This is known as a herd mentality. The author key idea here is that market are not just a number. They are reflection of a human psychology. If we look at the market cycle, shows here we can clearly see four stages: euphoria, panic, despair, and recovery. When investors are excited, price rapidly increase. This is a euphoria. Then fear starts building, leading to panic. After that come to despair, where confidence is very low. And finally, recovery begins and cycle repeats. According to the author, this cycle keeps repeating because human emotions don't change. So, market patterns are often predictable from a behavior point of view. Now, move on to the next slide. So, the next slide is the reality of a return fundamental and speculations. If we look at a historical example like 1991 to 1992, Hudson Mehta boom, we can see that out of the total return, a large proportions came from speculations, while only small part came from a fundamental. Similarly, during the 2007 to 2008 pre-cash period, speculations again contribute more to return than actual company performance. So, what does this tell us? It shows a clear disconnect between market price and real value. Price rise not only because business performance well, but also because investor became overly optimistic. The author highlights that investors often mistake rising price for a true value when in reality it may just be a speculation. It also changed how we understand risk. Risk is not just about how good company is, it also about how much you are paying for. As shows here, when price increase due to hype, the risk also increase, even if the company fundamentals strong. So the author perspective is very clear. Overpaying for a good company can still be a bad investor. Now, finally, coming to the conclusion. So, to conclude, we discussed the key aspects of our topic how markets are driven by fear and greed, how investor psychology lead to herd mentality, and how speculation often create a gap between price and a real value. This shows how important behavioral finance in a real life investing and decision making. We hope this presentation helped you understand the topic topic clear and gave you a new perspective on how market actually work. Thank you for your time and attention.